Howdy, Jacob here. Today we're looking at Monster Beverage Corporation. This company's growth is stupendous. So I just wanted to share this that they sold in 2004 for less than 60 cents, which would make them a 100 bagger in 20 years. And then they sold for 6 cents in 2003. So over a 21-year period, you 1000x that's unbelievable, very impressive. If you were one of those early investors, damn, props to you. You deserve big old thumbs up. 1000x, you're looking at $60 million back in 2003, and they're now a $63 billion corporation. Okay, presume that's not most of us though. So let's look at what the business is worth today. That's what I care about. Hindsight's 2020. Let's look at what we can do in the future. Come on. 63 billion on market cap, 60 billion enterprise value in the beverages industry. I mean, I see them selling very heavily in the front of your classic Walmarts and your big stores like that. I think a lot of people just take a quick one to get some energy in them. And darn, they have great returns on invested capital. Growth rate is humongous. In the last 10 years, their lowest revenue growth was 9%, and their highest 21%, second highest 13%. So basically 9 to 13 production like crazy. Can they do that into the future? I'm a little skeptical of it. I'm just say that now. I'm a little bit skeptical that they're going to be able to grow at those rates. Will that mean I might not be able to buy Monster? Maybe. But that's fine with me as long as I know what a business I'm buying and I'm buying into a business I think is going to give me the return I'm looking for. Let's look at this balance sheet. So 2.3 billion cash on hand, no short-term debt, no long-term debt. Beautiful from a balance sheet perspective. Very safe company. Return on invested capital has gone up quite a bit, so they are reinvesting quite a bit of their money back into the business, but they're still producing a hefty amount of free cash flow. Use of cash, quite a bit of acquisition activity, quite a bit of share repurchases, and then, like I said, a little bit of investing into themselves. Um, yeah, I mean, let's start making some assumptions here. I already have a feeling it's going to be a bit excessive. I mean, I don't think that they can grow 10% a year. I could be wrong. I hope I'm wrong. If you're investing in them, I hope I'm wrong. But I'm fine not owning a company based on me setting assumptions that I think are reasonable in my perspective and in my eyes. I think 8% growth, sure. Maybe. I mean, do I still think that's pretty hefty? I mean, personally, yeah, but they've just been so consistent. Let's put a premium on their P and price to free cash flow at 22. Personally, I think that's a very hefty premium or a very hefty price to earnings and free cash flow based on the end of 7 years. Do I still think have growth in excess of the market? I absolutely do. But I think it's a little bit of growth in excess of market. It's a little bit of the moat that they have. It's a little bit of the consistency they have. But I'm just not willing to go much greater than that. I could see somebody possibly put in 25 on a PE side, but anything more, personally, I think is a bit excessive and to me quantifies either a lack of understanding of what a P and price to free cash flow should be, or you think that the revenue growth and margins are well in excess of what I do. And then good for you. I mean, again, to each their own. I'm probably going to be wrong on 99.99. I mean, I'll be wrong on 100% of these probably, but my goal is to be conservative in my investments so that in reality, I hope that I'm actually getting greater than the discount rate return that I'm looking for as the business turns out to be greater than the assumptions I set in place. But for now, let's get back into it. I think I keep taking us off track. Apologies there. So let's do 25% on the earnings margin, 23 on the free cash flow margin. Let's say they buy back 0.5% a year, because that would be what, 600, 300 million. 300 million on average. Let's do 1%. Let's give them benefit of the doubt. Say they buy back 600 million a year in free cash flow, and that's 600 million now. That's going to be maybe 670, 730 a year and two from now. No dividends paid. So yeah, it just looks a bit expensive at this price. I'm saying it needs to fall 60% before you get a 15% return given these assumptions. do your own assumptions, make your own valuation. This is just my perspective. Do I think that I would have made I would have bought it 20 years ago? Very likely not. I probably wouldn't have. I would have missed out on a thousand bagger. So I'm going to. There's going to be times where I miss out on those things, but personally, and my understanding of value investing that makes sense to me is buying part of a business and being conservative with your estimates due to the fact that not everything's going to pan out the way you might think it does. Hopefully, you enjoy the video and have a great rest of your day. Thank you so much.